Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by Stewart Investors. As such, the sponsor may suggest topics for discussion, but final control over the podcast remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Pablo Berrutti, who is Senior Investment Specialist, Sustainable Funds Group at Stewart Investors. Can you tell me a little bit how you got involved in sustainable investing and what sort of your ideas are around what sustainable investing is, what the definition is, and sort of your ideas there?
Going way back to a former life as a risk management and compliance professional, and this is sort of 2005, 6, 7, in and around that period. I was always really interested in, particularly in environmental issues, but generally in sustainability issues more broadly. And I'd started to make the connection, which I hadn't done in my career to that point for some reason, which I think is probably was endemic across the industry at the time, that climate change was a risk, that climate change ought to be a risk that we managed like other risks, and yet it wasn't in our risk register, it wasn't in our risk management strategy, we didn't have it referenced in our investment policies and other types of risk management collateral that we had across the organization and plans. And so I started to advocate for why wouldn't we include this? And I think for a couple of years it didn't resonate. Like I was always politely listened to, but there wasn't a lot of change. We started to do small things like filling out carbon disclosure project and measuring our own footprint, but it was a bit too hard to wrap your arms around in terms of how these issues might impact from whether it's from an investment perspective or as an investment organization. And then, fortunate for me, but I guess unfortunate for the firm, we missed out on a mandate. And one of the reasons that we didn't win that mandate was because the fund manager said that when he was asked, what's your approach to ESG? He said, what's ESG? And that was one of the top reasons that was given for not winning that mandate. And so I got a call from the chief investment officer at the time saying, oh, come up, you're the guy always talking about climate change. What's this ESG stuff? And of course, I didn't know what ESG was. I just knew that I cared about these other issues. And so did some research, started to look at what was happening across the market, and it was clear that things were changing. So it was the principles for responsible investment were only a couple of years old at that time. There were more and more asset owners, so some of our clients who were signing up to the principles. There were groups forming, like the Investor Group on Climate Change. And so as we went and investigated this issue, this is a perpetual, it became more and more clear that we needed to have a position on it. And so that turned into a role for myself. And it was a really nice way to start thinking about sustainable investment, because we had a very strong investment process. So the perpetual process is very similar in some respects to Stewart Investors, strong focus on quality of companies, on the balance sheet strength, on the quality of management. So there's that qualitative aspect to that. And so there were aspects which you kind of thought sustainability played a role, but it wasn't formalized. We didn't have data flowing through. We didn't have the discussions happening perhaps as we ought to, but we did have an excellent ethical SRI fund. So I started out helping manage the screens for that, start to think about process and very importantly about investment governance, and really built it from the ground up there.
Yeah.
About a year into that, I then joined the Responsible Investment Association of Australasia board and became chair a little while after that, and chaired for 6 years, and was on the Investor Group on Climate Change board over that period. And I'd also moved after a couple of years in that role at Perpetual to Colonial First State Global Asset Management, which is now First Sentier Investors, to lead responsible investment in Asia Pacific for the firm. And that was, again, a very different type of context. Perpetual very Aussie, equities focused, where, at least at that time, and GAM being a large global business investing all around the world. And one of the teams who inspired me most in my time at GAM was Stewart Investors, which I now work in and have been with the team for the last almost 3 years. Saw the connection between sustainability, long-term returns, really as a investor that considered the quality of management as being really key to how businesses are able to create and sustain value over time. Took that idea to the next level when thinking about sustainability headwinds and tailwinds, and how companies that were contributing positively to sustainable development and benefiting from that, like the way that they make money makes the world a better place, then that's got to be good for them over the long run, and particularly if they're run by good quality management. That to me seemed like the right way to do it, and so it's been great to be able to now work with a team, and I sometimes describe it as I spent most of my career prodding and poking and trying to encourage people to adopt sustainable investment practices, and now I spend most of my time trying to keep up with the rest of the team who have been doing it for a long, long time.
So your background started originally in as a risk specialist, and often I ask the question about sustainable investing: is it a risk management tool, or is it actually a performance tool? In the sense that sustainable can sometimes be seen as well as being similar to sort of a quality approach, where sustainable businesses in the long run will just perform better. What's your point of view as sort of being a risk specialist? I would initially say, okay, risk, but you're also have that quality approach. What is your view on it?
So, I think they're two sides of the same coin, and ESG and sustainability issues manifest in a few different ways. And so I to simplify it, I've always thought about it in sort of 3 areas. And so there's the marginal benefits that come from being a better run business. And so you're more efficient, your costs are lower, you're able to retain and engage your people better, and so they work harder and put more discretionary effort in, and you have a good culture, and so you don't have to, you can trust that the right things are going to happen in the right ways throughout the organization, and there's lots of evidence across different aspects of, or different ESG management issues that they have those kind of marginal benefits. Then you have, and these are no doubt linked in terms of, so better management of ESG issues, producing those marginal benefits over time. But then you have the blow-ups, of course, and they're quite spectacular. And the BP oil spill still is probably one of the most striking examples of that. But we've had so many, of course, over the decade since, and they're not predictable, I think, individual events as such. But you can look at the quality of management. You can look at how the organization approaches sustainability issues, and say that one organization is more likely to get itself into trouble than another because of the management of those issues. And so there's a risk management aspect there. And then the largest of them all, and perhaps the hardest to really define and nail down, certainly in a quantitative sense, is the structural shifts that are running through the economy today. And so whether that's decarbonisation and electrification, whether it's more sustainable food systems and consumers wanting to have more sustainable products and services, whether it's the waste challenge that we have to confront, if it's plastics or other forms of waste, even just still the systemic underpayment of women for doing the same job as men. These are the types of structural changes that you can see unfolding, and companies that can position themselves well for that are likely to be able to capture those tailwinds. We call them tailwinds, and we also talk about headwinds for companies that aren't well positioned for those structural changes. And so I think depending on what your focus is in terms of how you're thinking about ESG issues and sustainability issues, then you can look at it both as a risk or return driver, and ultimately that they are two sides of the same coin.
Yeah, I liked when you said that originally, when you're looking at this and you were thinking about climate change, you didn't necessarily have an ESG lens, because you were like, what is ESG? And in some of the writings that you've done recently, I still get a sense that you're not particularly a fan of ESG metrics. And I think you have in one article you wrote something around sustainable metrics can be sometimes like coloring by numbers. Can you explain that a little bit?
Sure, it certainly feels that way. So we, as an investment group at Stewart Investors, have a strong focus on the qualitative aspects of management quality, franchise quality, and financials. And even in those areas, while financials you think are absolutely quantitative, you can take some qualitative insights from the way companies choose to manage their accounts, what they include, what they don't include, how quickly they pay suppliers, how much tax they pay. So there's a range of insights that you can draw even from the most quantitative of those areas. And then they become more qualitative after that, like how trusted is the business? How does it deal with its stakeholders? Is it likely to be in line for regulatory sanction or tightening because of the nature of their business model being exploitative or not? And management quality is the one that we look at the most, because we're really looking for managers who can look past the short term and set their businesses up for long-term success. And so often we've really liked the family led companies, particularly in Asia Pacific, where we did a lot of our investing in the early days and still do today.
Yeah. So what are some of the pitfalls that you can encounter when you stay too close to sort of generic metrics?
And so when you have that kind of mindset and you're looking for those type of things, there's a lot that is missed when you then try and deal with it in a metricated fashion. And so take an ESG rating from any of the providers, and generally you'll have maybe 100, 150 factors that have all been weighted in some black boxes to their specific materiality for a particular company or a particular index, and they get rolled up to a score. Whereas the issues that might be built somewhere into that rating become buried through aggregation. And so you don't really get investment insight out of them, at least not if you're investing bottom up. You might be able to use them in a kind of a top down approach, but for us that doesn't make a lot of sense. So there's the sin of aggregation, but then there's also the sin of measuring the wrong things. And so take carbon as a great example. So you have carbon footprinting, which is now very common, and the TCFD talk calls for carbon footprinting of companies and investment portfolios as well. And it is undoubtedly a useful tool, but if you look at it in isolation, you miss the fact that the reserves of a fossil fuel company aren't captured in its carbon footprint or the emissions that come from itself after it's sold its products and services. And similarly, the benefits of companies who are delivering solutions to climate change, reducing emissions through their products and services, that's not captured either. The other challenge, of course, with carbon footprinting is that we still have a diversity of ways in which companies are choosing to set their boundaries and measure. So you'd think that this should be a very structured and systematic approach to measuring this particular factor. But yet there's still, I think, half the companies globally don't disclose at all, and the half that do, how much can you rely on those measures? And so for a range of reasons, you can say that, yes, this is important, but you also need to treat it with an appropriate grain of salt. And you also need to think about, well, how are the managers of these companies that I'm investing in? Can I rely on them? Can I trust them to give me good information that's actually going to help me make better informed investment decisions? And so you see all the discussion around greenwashing and what have you. So they're just two examples, I guess, through aggregation or through measuring the wrong things or taking too narrow a view of an issue, where metrics can get you into trouble.
Yeah. Let's stay with that question around carbon for a moment. So we see increasingly more institutional investors commit to that net zero carbon target by 2050, some of them putting some interim measures in place as well. But it seems that a lot of sort of the initial phase is around setting a different benchmark that is just a lower carbon benchmark and filtering out some of these most heavy polluters. What is sort of your approach to this? Are there more easy gains or more efficient ways of tackling this problem?
So I think if you think about the broader problem, then clearly more capital needs to go into the types of businesses and assets that are driving the low carbon economy, and less of it needs to go into high carbon assets. So that's a kind of a very basic, take a step back and think about it that way. But then there's a whole range of companies who are involved in the transition to a low carbon economy that need to go faster, need to focus on other parts of their business to help those grow and adapt. And so from an investor perspective, I think engagement plays probably the most clear role, but yet often the hardest to define and the hardest to measure role that we can contribute to that transition. And also I think there's other aspects so that you can engage, you can vote. The shareholder resolutions are quite common now in terms of climate and other ESG issues, supporting those in. But then I think there's other aspects of the policy landscape needs to change to support a low carbon transition as well. And so understanding what your companies are doing in relation to political lobbying or other aspects in terms of how they market themselves and those types of things, I think is a really important thing for investors to be aware of. It's not just about the emissions and it's not just about the products and services. Those other aspects of how companies conduct themselves are really critical, and investors need to take that holistic view if they really want to help shepherd companies along. Now, I think there's this endless debate around engagement versus divestment.
Yeah,
and I think actually that they're both wrong to see if you're focused on one or the other. Like, both are really important. And so the way that I tend to think about it is that you need to have companies that are willing and able to change. If they're not, then you're probably going to burn your capital. And from our perspective, we consider capital preservation as a key part of our role as stewards of our clients' capital. And so we look at fossil fuel companies and we can't see how they're going to transition profitably. The risks just seem too great to take with our clients' capital. And so we're not going to invest in those types of companies because of the risks involved. However, there are a whole range of other companies, as I mentioned before, where you do need to really try and get them to improve their disclosure, to set targets, to invest more capital, to focus on research and development in certain areas. So all of those types of aspects where you have companies who are both willing and able to change, and you can engage as a responsible steward over a long period of time, because I think the worst type of engagement is coming in as a relatively short-term minded shareholder and just banging on the table and demanding things to change. I think if you're building relationships and really trying to have that 10-year plus view of investing, that's a much more constructive way to try and deliver change within a company. And so that's the approach that we take, is really focus on the companies that we think are well positioned for that sustainable development transition, and engage with them to try and help them be better.
Yeah. So do you get involved as well with shareholder resolutions? Do you file your own resolutions?
We don't file our own, or haven't historically. I mean, we may do in the future. We could never count it out. We do support a large number of them when they do come up, but there aren't that many that have actually been proposed for our companies. Kind of interesting things where so much discussion is around shareholder resolutions, say at fossil fuel companies, but they're companies that we don't tend to invest in. We actually like the companies that we're investing in. We want them to succeed. We think that they are well positioned for sustainable development, that they act ethically, that they have management who have high levels of integrity. They're core parts of what we're looking for in companies. And so those companies tend not to have as many shareholder resolutions placed on their register. We tend to want to engage with those companies in a constructive way over time, rather than taking a more adversarial approach through a shareholder resolution. Where we see the most shareholder resolutions tends to be in the US, because there is that more adversarial culture in that market in terms of resolutions. And often you sometimes see companies with half a dozen different resolutions from different shareholders in the US. And I think they certainly they have a role, and they're incredibly powerful as a signal. So they're very important. And so that's why I don't count it out in future as something that we might do. But it's just not, because of the nature of our investing, it's not something that's really been needed at this stage.
So you're a bottom-up stock picker, and so you basically invest in the companies that you think are good. Do you still use negative screens to filter out certain unsustainable companies?
It's an interesting question, because so we rather than starting with a universe of 6,000 companies in the ACWI or whatever the benchmark might be, we start with a blank piece of paper, and we try to build a portfolio based on the quality companies that we can find literally from that blank page. And so the idea of kind of screening companies out doesn't really make sense to us, because we're thinking about it from the opposite direction, and the companies that we would not invest in because of their sustainability positioning or because they don't have the quality attributes that we're looking for would undoubtedly get knocked out by negative screens if you were to take that approach. But it's just not the way that we think about things. However, it is extremely important for our clients to be confident that we won't invest in things that are inconsistent with our investment philosophy or approach. It's really important for our clients to understand where we stand on certain issues and what they can expect from us. And so we have a position statement on controversial and harmful products and services where we really lay out in detail what clients can reasonably expect from us in our investing, and what companies we wouldn't allocate capital to. And we have the types of checks and balances that you would expect to have in any investment organization. So pre-trade compliance checks. So we do have an external provider that just ensures that check is in place before we buy a new company. We have those quarterly checks that come through to see where activities perhaps are in certain areas that we wouldn't ordinarily be comfortable with or wouldn't be investing in. We also have controversy monitoring, and that comes through daily from a research provider called RepRisk. And so if companies are in the newspapers for the wrong reasons, we can start to take that on board and engage with companies where the issue warrants it, and try and really understand whether the assessment that we've made around the quality of that business ought to change as a result of some of these issues. Because ultimately, all of these things come back to how do we think about the quality of a company and its ability to deliver value over the long run.
Yeah. So we're in the middle of quite a strange period where we had pandemics going on, we had natural disasters, and now we also have the invasion in Ukraine. On that last bit, has this changed sort of the perspective for some of the companies that you are investing in? So there is on one hand this idea that countries want to decrease their reliance on oil and gas for obvious reasons in this conflict, and that this might push the development of renewable energy. On the other hand, you mentioned around those restrictions of a reputational risk, and has this sort of shifted with the recent conflict?
From an energy side of things, the transition is well underway. The cost competitiveness of renewables, increasingly of batteries and other forms of technology which will allow us to shift to clean and green energy was already well underway. And whenever you see energy prices rise, then that in the medium or longer term is going to benefit those cleaner technologies, because it makes them even more cost beneficial to operate that way. It makes energy efficiency more cost beneficial to undertake those programs. In the short term, of course, there's serious ructions and genuine demand. People die if they can't get the heating that they need in Europe, where it gets very cold in the winter. And so I think, unfortunately, because of how long we've waited to really accelerate the transition to renewables and to really deal with climate change as seriously as what we need to, and we're still not there at that point yet. We're going to face issues where they come up, like whether it's COVID or whether it's a conflict like Russia and Ukraine, volatility in those areas. And so companies, when we think about the companies that we invest in, and we always struggled with Russia, because even when you find good quality companies in Russia with good stewards, the oligarchs would often move in, and you worry about corruption and you worry about those types of issues. And so we didn't have any companies listed in Russia. And I think for sustainability conscious investors or focused investors, you'd have to wonder now, where you have indexes which are pulling out the entire countries, even though they were relatively small, but taking it all out of the benchmark, but you can't get the capital out because the stock market's closed. And so what type of thinking ought to have been happening well before the conflict in terms of the type of market that Russia is to invest in, and whether you can actually invest in good quality sustainable companies in that country. So it does pose that question, I think, the reliance on benchmarks for some of these things, and whether that's reasonable or sensible. And then from a longer term perspective, I think what both COVID and the invasion of Ukraine have shown is that we need businesses that are more resilient to unpredictable events and changes. And so we had, I think, up until COVID a culture of sort of just-in-time supply chains and keeping low stores of inventory, and big focus on working capital and those types of issues, which are all a philosophy that works where you don't have these big disruptions. But when you do, we've seen the supply chain issues that have then reverberated around the world. And so I think when investors are kind of thinking about companies that they're investing in, and this is whether you're thinking about it from a sustainability perspective or not, those types of things, like having a strong balance sheet so you can endure financial calamity and come through the other side stronger and able to invest through those types of issues, having really well understood supply chains, and sustainability is a big part of that. Like if your supply chains aren't exploitative, if you're really concerned about deforestation impacts, for instance, if you're a consumer goods companies, you're doing more work on your supply chains, which will help you reshape your supply chains if something goes wrong and if things happen badly. And so I think it is a different example, but just another example of how companies that are really leading the charge on some of these sustainability issues can come out of situations like what we've experienced in both the pandemic and with this conflict stronger.
We've also seen some quite large multinationals pull out of the Russian market, basically abandoning their operations there. Do you see that as sort of a vindication of ESG, where finally this is taken serious? Because I thought to a degree it was relatively surprising by how quickly companies move to just distance themselves from the Russian market, which I don't know if that would have happened like 10, 15 years ago, where perhaps it wasn't as high on the agenda. Do you see it as a form of where people are more aware of sustainable issues?
I think people are definitely more aware of sustainable issues. There's no question in my mind about that. And you see that in lots of different examples, but I'm not sure that's one of them. I think this is we haven't seen a conflict of this scale in Europe since the end of the Second World War. The sanctions have come through reasonably quickly and are fairly deep, and there may well be more. And so how much of it is companies really trying to get out and preserve what they can in the face of those impending challenges that who can predict how this war will end, or whether it's companies taking more of a moral or a sustainability focused perspective. You'd have to ask each one individually. Really, it's hard to say. I think the areas where you do see a lot of positive change in relation to companies moving in these areas is there's still this dichotomy where COVID is actually a really good example, where you saw some companies who went to a lot of effort to keep on staff, who invested in R&D throughout the pandemic so that they could come out stronger, who kept suppliers on even to help put lifelines there because they knew that they would need those supply chains to be able to bounce back at the end of the pandemic. And then you saw other companies who operated with that shorter term horizon, trying to satisfy the markets on a quarter by quarter basis, cutting staff, cutting back in other areas, looking to so the different approaches by different companies, I think, is really stark in these types of situations where there's a big disruption. And for us, we try to focus on those companies that try to look through the immediate crisis, who are already strong coming into the crisis, but who can look through it and really try and think about their businesses 10 years out and what the things that they need to do now in order to be able to cement that future.
Yeah. Did it lead to any sort of surprises within the portfolio that you have, where either some companies were not reacting in the way that you were expecting?
Not so much during COVID. I mean, we had, a great example of a company that reacted the way we would expect is in our global emerging markets fund. We invest in a company called EPAM. They're US listed, but they have a lot of, they were started by a Belarusian who has a lot of staff in Ukraine, a lot of staff in Russia and other parts of Eastern Europe. They're an IT consultancy type business, very high quality in every respect, growing really strongly. And they have come out with the conflict and said quite clearly they cannot provide guidance clearly because of what is going on. And their focus is on their people and trying to get their people to safety where that's possible, trying to back up their operations. So I think it was about half their staff are in that area and the rest in other countries. And so trying to help look after their clients to ensure that they can be still looked after through those other locations, but they've fundamentally said that their primary concern is the safety and welfare of their people, and that's what we would expect, and that's what we would want to see. And so that those types of things are encouraging in the short term. They've clearly, like their share price suffered as a result. As you would expect, the market tends to react first and ask questions later, and so we still see that over the long run the company can build back better, but obviously there is always that question mark about how much damage can any individual firm sustain, and so it's an active discussion internally as to their prospects going forward. But we feel ultimately like the quality of the business and the way that they'd set themselves up allows them to potentially come out of this better at the other end.
Yeah, for sure. Now, that's an IT company, and we talked a little bit earlier about technology companies before we started the podcast and some of the changes that happened there. From a sustainability point of view, are you concerned about some of these very large technology companies and sort of how they influence the market, or is it simply a matter of we just don't invest in those?
I think we've tended not to. We invest in a lot of technology companies, but tended not to invest in B2C, business to consumer technology companies. There are some exceptions. Generally, we like B2B technology companies better. We feel as though, particularly at the super large end, we wonder about how they can achieve sustainable growth in the long run. We look at the way their size and their market dominance and whether that is sustainable, whether regulators are going to step in and try to rein that in. We've obviously seen all of the ethical lapses in relation to privacy, in relation to the way that consumers' data is used and shared, and even in relation to the whole issues around fake news and politics. And so that has been a concern that's weighed on us and sort of prevented us from investing in some of those companies, because we haven't been able to get comfortable around the quality of the management, around the quality and sustainability of the growth. Whereas when you look at companies that are supporting other businesses, they tend to, their customers and the people that they service are the same. Whereas I think with a lot of B2C companies, particularly in the social media space, their customers are not the same. So if you're not paying for the service, you are the product. And so that type of thinking, which poses all sorts of dilemmas for these types of companies. To give you some examples, Taiwan Semiconductor, one of the highest quality companies in Asia, maybe the world, really well managed, prudently managed over the long run, have been able to show their innovation and their quality. And so that's a type of technology company that we can get behind for the long term. And we think that the way that they're developing their business is contributing to a lot of sustainable development drivers, whether it's from access to education and information in emerging markets, through to driving the transition in energy and transportation. And so those types of companies, I think, are a lot more understandable for us, and also a lot higher quality over the long run.
Yeah. It's interesting because I read an article by a colleague of yours that gives some stats around what's happening in sort of the corporate space around technology companies. And it was talking about the amount of acquisitions that take place that sort of fly a little bit under the radar because they're below the 5% sort of threshold. And I think it mentioned the statistic there that in 2019, there were 819 small companies that were being taken over without them having to report on it. When you look at statistics like that, does it worry you?
I think it is worrying generally that you have such, I mean, you look at the returns from the FANG, we're traditionally known as the FANG companies, have dominated the market for a long time, and they make up a very large proportion of US profits even. So these are dominant players in their markets. And how does competition emerge in those spheres when the smaller companies get bought up, and so then how do you actually get markets to function properly in those types of dimensions? How do you ensure that people are treated fairly, and how do you even ensure that appropriate rates of tax, for instance, are being paid? Because those technology companies, the ones that have driven all of those returns, also pay a disproportionately lower rate of tax than what is the standard sticker rate in the markets where they're listed. And so I think it poses myriad concerns, both for their investors, but for regulators, which potentially and governments, which potentially will come in to try and balance that out. But it is, I think it's really uncertain as to how that is going to evolve. And we've also seen, I guess, as globalization, we've sort of seen more of a regionalization in more recent times, and we've seen the posture that China has taken towards some of its technology companies and some of its extremely wealthy entrepreneurs. And so I don't think that there's a one size fits all approach for managing these types of issues, but I don't think it's at all clear how governments, say in the US or Europe, are going to deal with the types of issues that this has brought about.
And of course, technology is a very sort of broad term. So we were talking a little bit earlier about everything these days is a technology company. But from sort of a sustainable perspective, are there any sort of technologies that you're really excited about, or areas that you think can really help the sustainable area?
It's funny because there's a lot of discussion around renewable energy, distributed grids, electric vehicles, all highly technology reliant transformations. But I think some of the things that I think are really interesting that will have a huge impact that don't get that level of attention. So we invest in a company called Spirax Sarco. They are specialists in steam. So you don't get much older a technology than steam. You know, they used to run the trains on them. They're used across the food system. They're used across medical. They're used in industrial applications in factories. And a lot of the steam is produced by gas boilers. And Spirax is investing in how do they electrify the production of the steam, which I guess from the challenges that we mentioned earlier around Russia and Ukraine and access to gas, I mean, that's an extra motivation for wanting to do that. But from a climate perspective, the impacts are far-reaching if you can actually transition those gas-fired boilers into electric-fired boilers or electric boilers and run them off renewables. You know, other technologies like hot water heating. So it takes a huge amount of energy to heat hot water. We invest in a company called A.O. Smith, who make the most efficient hot water heaters in the world. They've got a really big presence in China, interestingly enough, and have partnered with China's partners. They're delivering their highly efficient products into that market, and also leading the way on things like heat pumps and solar hot water systems. Huge amounts of energy that go into those types of technologies. It was a bit old hat and a bit boring, nowhere near as exciting as EVs and those types of things. And they're companies that have this tailwind behind them where they'll be able to sustain their growth for decades into the future as they transform the underlying infrastructure of the economy to cleaner, more efficient things. And then I think the ones that are interesting, which aren't sort of specifically technology as such, but they're companies who are using technology in really clever ways. And so, for instance, HDFC is a housing development finance corporation. It's an Indian mortgage lender primarily. It also owns a bank and insurance company, has most of its branches in rural areas of India in the non-large cities, has a large agricultural footprint as well as a result of that. And so when you think about how, and this again is the color by numbers example that I was getting at before, in terms of if you just think about the traditional sustainability metrics, you might look at, how much access to finance are they giving to underserved communities? And that's really important, and they do that extremely well. But these particular underserved communities are on the front lines of deforestation, are on the front lines of using fertilizers and unsustainable farming practices. And they've been developing technology platforms which they deliver to their agricultural-based clients, which give them pricing transparency so they can get better prices for their goods and services, that give them education and ways of testing the soil and understanding what nutrients are needed so they don't have to use as many of the fossil-based fertilizers as what they might otherwise do in their farming, and also helping them to more sustainably intensify their yields, which hopefully then leads on to lower demand for deforestation, which is another behavior they also encourage through conservation and that idea of traceability of the supply chain up through to the consumer companies. And it's those types of technologies which really facilitate that. But you need, whether it's a banking company or whether it's a consumer goods companies, to then apply those technologies to their supply chains in a way that then can deliver those outcomes. And so I find that part really fascinating. And again, it's a mark of that quality of a company that they're able to do that, because it'll make them more resilient in the future.
Yeah, fascinating. I want to talk a little bit about diversity and inclusion, because Stewart Investors has commissioned a research project with the University of Technology in Sydney, which is around recruitment and retention and some of the how you can improve diversity through that. Can you tell me a little bit about sort of the background of the study and how it fits in with sort of your broader investment decision-making process?
Absolutely. So diversity is something that we think about for all of the companies we invest in. We think about it from the context that companies that have, whether it's gender, cultural, socioeconomic, that have those voices around the table are going to be able to make better decisions because they're including the views of more people. And we talk about diversity and inclusion. The inclusion bit is absolutely critical, has to almost come first because if you have the diversity, but you're not taking the views on board, or if it's not changing the way that you think about your company and how you're going to operate, there's not much good in that. So we often commission research where we're really trying to understand some of the more systemic issues that run through, whether it's a sector or whether it's issue based. We've found that, again, the ESG ratings haven't been particularly helpful, but when we go out and tender for research from specialists in the field, we get much deeper insights, and we can then apply that to our engagement or our investing. And in the case of diversity, we really wanted to understand who were the companies that were making a difference and actually able to change over a relatively short period of time to improve the representation in board, in management, the gender equity, pay gap, those types of issues. And so we commissioned UTS to do this research, and they looked at the types of areas, so whether it's training and development, whether it's maternity and parental leave, whether it is pay-related issues, flexibility, all of the types of characteristics, and then found a range of case studies. One of the examples were really interesting was a technology software company where they had women that were coming through that had qualifications in technology but weren't software engineers, and so developed an apprenticeship style program where they could transition them through to software engineers and to then improve the diversity in that area, because they knew that was important. They knew it was important from a pipeline perspective because they needed the talent. And so those types of interventions are really interesting and I think worth exploring for companies. But we've also seen, so Halma is a conglomerate based in the UK that invests in a lot of other businesses. It wholly owns those other businesses, all focused on making the world a better place in health, in infrastructure, and safety. And they, over the course of 6 years or so, managed to completely transform their board and their senior management ranks. So they went from having almost no women to having almost half in both spheres. And that came from leadership. It was really like there was programs and all of the other things that happen that need to happen, but it really came from the CEO who recognized the benefits and was willing to drive that change throughout the organization. And so I think you need to have the leadership, you need to have in interesting ways to make the interventions. And what that allowed us to do then was to send that report to the top 10 companies that we held in each of our strategies and encourage them to look at the results, reflect on their own approach to diversity and where they might be able to improve. And then that's then been the baseline, I guess, for ongoing engagement with those companies that can improve in that area.
Yeah, very interesting. Are there any similar projects in the pipeline, research that you have commissioned?
So we had a couple that have come in recently. So conflict minerals is a collaborative engagement that we've been working on with a number of other investors through the Principles for Responsible Investing. And again, it has that hallmark as well, being of this systemic issue cuts across the IT sector. We have exposure to semiconductors, to a number of other technologies which potentially would have conflict minerals in them. We wanted to understand what good practice look like. How can you make an effective intervention in this area? So we commissioned 2 pieces of research and then have used those to help support a broader investor collaboration so that we could really try and get companies to focus more on that issue and to really sort the supply chain out, because that's the bit that's still, the traceability in those supply chains is still quite poor. We also did another one recently on smallholder farmers. And so I mentioned the HDFC example just a moment ago. And it struck us because we were engaging with a number of consumer goods companies around deforestation in 2019. All of them raised the issue of smallholder farmers because they are at the front lines of these issues. It'd probably shock you to find that. So 40% of the palm oil that's produced in the world is from smallholder farmers.
Right.
70 or 80% of the coffee is produced by smallholder farmers. So they're essential parts of the supply chain for companies like Nestle and Unilever and many others. And so they referred to this very important group as being on the front lines of deforestation, but they all had different approaches for how they dealt with it. And so we commissioned a piece of research to understand what does good practice look like, and again that can form the basis of engagement for the future. And HDFC is one example where we found a number of really good practices after the research had come in, because we better knew what to look for at that point. But you had a range of initiatives, and the most important, or the ones that were most effective, were the ones that took a bit of a system view. It's not just about premium pricing, although that's important, but it's around building infrastructure, the education for kids, so you don't have child labor coming into, less of an incentive around that. The access to markets, how you deal with intermediation in markets, certification systems. So there's a range of things. There's no panacea or silver bullet for these complex issues, but we're then able to, in a more informed way, engage with the companies that we're investing in, and really, I guess, assess the quality of their approach and feed that into our assessment of their quality overall.
Yeah. Let's finish up with a quick look at the Sustainable Development Goals. This seems to be an increasingly popular sort of framework to measure investments against in a sustainable sense. But at the same time, there's also a bit of greenwashing, or in this case, rainbow washing going on. What do you think of these goals? Are they a helpful framework, or are they just another color by numbers metric?
The SDGs are very useful because they are globally agreed goal or set of goals that humanity can aspire to. And so when we think about the headwinds and tailwinds that I've mentioned a few times through the course of this conversation, what do they look like in a decade, in 20 years' time? And the SDGs, they're out to 2030, but you could see the direction of travel, and you can sort of try to start to understand how companies are either contributing or not contributing, are holding back some of those goals. And so that sort of more general take a few steps back perspective, they're really useful. I think the problem is that they weren't designed as an investment metric or as a business set of indicators or things like that. They are then commonly misinterpreted or misused in the context of trying to show how you might be contributing as an investor or as a company to the SDGs. And I think there's three things that people can look out for, simple things, to help them understand whether companies are actually over egging their claims around the Sustainable Development Goals. So one is, how important is the issue to the company itself? And so are they deriving revenues from things which are helping promote those goals? Are they investing in research and development? What's their CapEx look like? The culture of the organization, so a bit less financial and more qualitatively focused around how they operate and how they do things. That starts to give you a picture of what it means to the company and whether the company sees it as a strategic imperative. Then it's, what does it mean for the issue itself? So is the company actually contributing in a way that's having a meaningful and demonstrable, not necessarily measurable, but demonstrable impact on the issue? And there's multiple ways that you can look at that. There are impact metrics, but again, it can come down to the management of supply chains and those types of issues to really understand how companies can have an impact on the goals. And then lastly is the balance. And this is the thing that's most often missing, is that there is no perfect company. There's certainly no perfect investor. And you need to be able to show, and these issues are really complicated and they're really hard. And so you need to be able to show that there are mistakes, there are areas where you're looking to improve because you haven't got that down pat yet. And so I think when you're reading a disclosure around the SDGs, if they're not actually helping you understand some of the challenges and the risks and the the learnings if they're not able to demonstrate how it's impacting the goals, and if they're not showing that it actually means something to the company as opposed to being a little bit of corporate philanthropy on the side, then you've got a reasonable idea of whether they're authentic.
Yeah, so you should make a good assessment of not just how they fit with the goals, but also what some of the risks are and challenges compared to the goals. I think you framed it well. Pablo, thank you very much for this conversation. It was great having you on the show.
Thanks, Walter. It was good to talk to you.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.